Hello everyone, in this video we're going over one more example for the income statement chapter. So this is for discontinued operations and we're just going to go through this one relatively quickly. I just wanted to show an example that has both a loss and a gain, okay? Because the tax effects are a little different. They basically end up being the same thing mathematically, but I just wanted to show it so that way you guys saw basically all the different combinations, okay? So we have CPA, copy, paste, and attach. CPA Corp is a manufacturing company that conducts its operations through numerous divisions. In 2017, the company's steel manufacturing division was suffering substantial losses, and the firm's board of directors voted to dispose of the division. Okay, so they're getting rid of the steel manufacturing division. During 2017, the division lost $100,000 before CPA was able to sell the division. On September 1st, 2017, CPA sold the division at a gain of $25,000. CPA's tax rate during all of 2017 was 40%. We're going to need that. Now it's just saying, okay, prepare a discontinued operations section of the CPA income statement for the year ended December 31. So again, we have our three-part heading, right? We don't we're not actually making an entire income statement, so I just said partial income statement, but everything is normal other than that, right? We have our company name of the statement, and then the year, okay? Then we're just making our disc ops section, discontinued operation. So we just say discontinued operation. Then we do our loss from operations of division less the tax reduction of $40,000, which ends up being $60,000. And then we're going to go over the math of that, but let's just go through really quickly. And then we have, which is because we had $100,000, and then we have to do the tax effect, okay? And we'll go through that in 1 second. And then we have the gain on the disposal of division less taxes, okay? So we sell it at $25,000 gain. We take out the taxes, we end up with 15. So our ending answer is negative 45. Okay, but let's actually go through kind of the intuition behind what's going on here. All right, so basically what happens is, just as a simple mathematical equation, what you generally want to do is you just want to take the number that they give you and you just want to multiply by 1 minus the tax rate. Okay, so in this case, that's going to be 1 minus 0.4, right? Our tax rate right here is 40%. That means this is also 0.6, right? Same thing, which means that at the end of the day, we want to end up with $60,000. Okay, we want to end up with $60,000 as a negative. Okay, and so the thing is that we can see that we ended up losing $100,000, but we actually only have to deduct $60,000. And why is that? It's because the government gives us a tax benefit for losing money, right? Because if you get taxed on your gains and revenues, it's not really fair if you can't deduct your losses, right? If your losses can't save you money, then it's not fair that your revenues get taxed, right? And so basically what happens is that you have this $100,000 of loss, right? And so this is reducing your income, whatever your income is, right? If your income is $500,000 or your income is whatever, it's reducing your income by exactly 100,000, right? And we can measure the tax effect of that reduction, okay? The way we would do that is we would literally just drop an example. And we would say, okay, let's say in one example, we have a loss of 100, and then in the other example, we have a loss of 0, okay? So in the example where we have a loss of 100, okay, our tax bill is gonna be $160,000, right? Because it's just 400,000 of taxable income times 0.4. But in the example where we don't have a loss, we have taxes, okay, of 200,000, right? And so we see that the difference in these taxes, the delta is $40,000, right? And the only reason for that is because we have a loss here, right? And so this loss saves us $40,000. Okay, so what happens is then we say, okay, we have a loss of 100,000, we save 40,000. So saving 40,000, right? Reducing expense by 40,000 is like the same thing as saying increasing income by 40,000. So it's basically 100,000 negative, okay, plus 40,000 positive equals 60,000 negative, okay? The last piece here, this one's easier to see just because it's a gain, but we'll go through it as well. So basically what happens is you have this $25,000 gain, okay, it tells you that right there, and then you tax it at 40%. Okay, and then you end up with $15,000, okay, because you have to list everything net of tax, right? That's the other thing we have to remember is within the disc ops section, we're listing everything net of tax, right? So we would take out taxes of 10,000 out of 25, and we end up at $15,000. Okay, so basically it goes both ways. That's what I'm trying to illustrate. Okay, if you have a gain, it actually gets taxed. Okay, and you have to basically subtract out the taxes. Okay, so it's 25 minus 10 equals 15. But in this case, when you have a loss, okay, you actually add back the reduction in the taxes. Okay, because you're actually like saving tax. Because again, on the gain you actually get taxed, but on the loss you save in tax, right? That's just fair. If the government is taxing us when we make money, they should give us a tax break when we lose money. Okay, and so that's basically how this one works. And that's the end of this lesson.